So I think there's a lot of variance around those estimates, and so economists, just like a lot of us, are guessing what's going to happen with consumer behavior. Hopefully in a post-virus world, we're still kind of unsure about how much fiscal stimulus we're going to get in some of these different regions, and so there's a lot of those things that can change throughout the year that will affect those numbers. Overall, what we're seeing is that we should get pretty strong growth out of emerging markets, at least some of the healthier ones. We should get pretty decent growth in the United States. Europe is one of the areas that's lagging pretty considerably, and that's partially based on how they've constructed the euro. So those countries have limited ability to do their own internal fiscal stimulus because they're not monetary sovereign, and so that's kind of a challenge that Europe has to go through. But overall, I think we're going to see strong growth in 2021, mainly just due to base effects, right? Because we're starting from such a beaten down level. But whether or not we kind of reach new highs in real GDP, I think remains an open question. I think by 2022 we would. I'd agree with that assessment, but I think that I can see why some economists don't think we'll do it in 2021. Because if you look, in the broad sense, unemployment is still the tricky area, especially in the United States. I mean, we lost, millions of jobs, and even though we've had a V-shaped recovery in asset prices, we've had a V-shaped recovery in certain indicators. Jobs have, done what I refer to as a backward square root sign recovery, where they had a quick V-shaped bounce after the immediate lockdowns ended, but then they started trailing sideways. And that's whether you look at, the unemployment rate or, just the employment to population ratio, all these different ways to measure how many people are in the workforce. And that's the part that's really struggling, and that's what can keep things down. So I think government expenditures are going to be a very large component for a lot of these GDP calculations. Because if you look, for example, in the United States, the amount of stimulus that they're expecting in 2021, earlier this it was the end of last calendar year, but it's part of this fiscal year where they did that 900 billion fiscal aid, and then now they're currently working on a 1.9 trillion dollar package, and potentially if that goes through, you're looking at maybe an infrastructure deal later this year. We'll see if they can get it through. I mean, they might not be able to because there's a very tight, political divide in Washington. I also think if you look at consumer spending, the services side in particular might have a pretty sharp rebound. I know myself that if I could travel, I'd certainly like to, because I have that pent-up demand from not really traveling much. And I think a lot of people are kind of in a similar boat. So that's kind of how I'm watching that. We've actually, other areas have held up well. Like we've already had strong retail spending and things like that, because people, they couldn't do some type of activity, so they redirected that money elsewhere. And so I think some of those places that have lagged are the places where you could see some growth.
So how does this translate to investment implications? So government expenditures are likely to continue growing. The services sector, well, the services is easy. You might just invest in some services-related stocks. But how do you invest in government expenditures growing?
Partially by investing in things that would do well in a more reflationary environment, and so higher inflation numbers, potentially higher bond yields. And so, for example, as we get later this spring, we're going to have, attractive base effects, right? So if you look at, because, inflation took a dip back in March and April, and then you're going to see somewhat higher inflation now, and it's, year over year numbers are going to be pretty significant because you're going back to that depressed period of last year. And basically, as long as these large fiscal expenditures continue, and they're, in large part being monetized by the banking system, that's a direct increase to the broad money supply. And so I think at least nominally, that pushes up a lot of prices of things. We've seen it in asset prices, and we're starting to get signs of inflationary pressures, especially in commodities, in shipping costs, things like that. And so I think that this can continue throughout 2021. And so investing in, for example, things that benefited from a steeper yield curve, which can include the banks, for example. I also, I'm structurally bullish on commodities, and so we've come pretty far, pretty fast in some of those. So I wouldn't be surprised to see more volatility, but especially for some of the low-cost producers, the strong balance sheets, the ones that I think are going to benefit from a multi-year trend. I still think that's an attractive area.
Speaking of inflation, yields are starting to tick up, especially on the long end. So do you see a correlation there? Is that because of higher inflation expectations?
Yeah, they've been tracking inflation expectations pretty closely. And so that's actually one of the things that held gold down, is that even though inflation is starting to tick up a little bit, and especially inflation expectations, which look forward a little bit, bond yields on the long end of the curve have been ticking up as well. And so the real yield of the 10-year Treasury has kind of hovered around negative 1% rather than continuing to go down, because that nominal yield's keeping up with it. And so if this were to continue, that actually presents, in addition to not being good for bondholders, because even though it's better for people buying into bonds now, it's bad for existing holders of bonds, because a yield going up means the prices are going down. It also potentially puts some pressure on the mega cap growth stocks, or even some of the smaller growth stocks, because a lot of them are based on the premise of very, very low discount rates to justify their high valuations. And so if you get that continued upward yield pressure, that can potentially put a lot of downward valuation pressure on some of those, those really high growth stocks that are in many cases trading at, 30, 40, or 50 times earnings.
Don't you find that ironic, which is that the yields rising should be an indication of people's expectations of an improving economy, which is why they're rising in the first place? Yet, like you said, it might push down valuations in some of these growth stocks. How do you, as an investor, does that mean I no longer want good news?
Well, it's funny. It depends on what sector you're looking at. And so, for example, a lot of people use those growth stocks as bond proxies. They say, they say these other areas are too risky. The energy is all over the place. Financials are over the place. All just buy Apple, for example. And they buy these growth stocks that are relatively, recession resistant, and that the problem is they end up buying them at almost any price. And so what we've seen is that over this past couple of years, especially in 2020, as we've had these lower yields and these more disinflationary expectations, people have piled into those growth stocks. And if you do the discounted cash flow analysis, they're more rate sensitive than value stocks that have more of their cash flows in the near term at lower valuations. And so as you get rising yields, that's bullish for some of the more cyclical things like financials or commodities and things like that, but it potentially puts pressure on some of these extremely expensive growth stocks that have been essentially serving as bond proxies because people didn't want to venture into some of those more cyclical industries.
Okay, and what about gold now? You mentioned that rising yields could happen as a result of inflation expectations. Well, isn't that just ironic again, because gold in itself is supposed to be an asset that protects you against inflation, yet when you have higher inflation expectations, yields rise and that pushes gold down, or at least weighs it down. So how do you, as an investor, how do you, meander around this discrepancy?
Yeah, the main discrepancy is that gold is not exactly an inflation hedge. It's a hedge against negative real yields.
Okay.
And so even if you look back in the 70s, the two big spikes that gold had were really during the two periods of time, the mid 70s and then the very end of that period, where negative real yields got down to negative 4%. And so those are the periods where you had that big spike in gold.